Don't finance your next car this way. Here's your problem. Your bank can approve you for one interest rate, and the dealership can legally hand you a completely different, higher one on the exact same loan. No lie on the paperwork, no red flag. Just a quiet gap that costs the average buyer over $1,000 and some buyers over $2,000 without them ever knowing it existed. Keep watching, and I'll show you the two words that expose this the second you ask for them. Words most dealerships hope you never say out loud. Mark didn't know to ask, and that one gap is what decided how much the dealership made off him. Here's what happened. Mark has great credit, the kind that should get him one of the best rates out there. The finance manager comes back fast with a number, $761 a month, approved on the spot. Mark checks it against one thing, his monthly budget. Can he afford $761 a month? Yes. So, in his head, the deal is done. That's the trap. He's not comparing this rate to what he qualifies for because he doesn't know that number exists. He's only checking it against what he can tolerate paying. And almost any number that fits inside your budget is going to feel like a win, even if it's not the best one available to you. He signs. What nobody told him was what the bank had approved him for. He never saw that number. He only saw the number the dealership decided to give him. That gap is where the money moves. When a dealership sets up your financing, they're not just a messenger between you and the bank. They're a middleman, and they're allowed to add their own markup on top. It's completely legal. It's built into the system on purpose. This should genuinely bother you. Nearly 8 out of 10 car loans set up through a dealership work exactly this way. The law doesn't require the dealer to tell you the markup exists. It's not a loophole, and it's not a mistake. It's just how the system was built. Mark wasn't unlucky. He was just normal. Now meet Alex. Same credit score as Mark. Shopping for the same car. But Alex did one thing differently. Before he ever set foot on a lot, he went straight to his own bank first. It wasn't some financial trick he'd learned. A few years back, a friend told him about getting stuck with a rate that felt off and never being able to prove it one way or the other. That stuck with Alex, not because he assumed every dealer was out to get him, but because he realized he had no way to check the number if he never saw a second one. So, this time, before he even test drove anything, he wanted a real offer sitting in his hand. 2 days later, his bank said yes. 5.5% sitting in his inbox in writing. A real offer, not a guess. When Alex sat down with the finance manager, he didn't ask, "What's my payment?" He asked a different question. "Can you beat 5.5%?" The finance manager paused, glanced at the letter, and said he needed to check with a few lenders. That pause said almost as much as the number that came back. That one sentence changes everything. Now the dealer has real competition sitting across the desk. Match what his own bank already gave him, come back with something better, or lose the deal entirely. It doesn't guarantee Alex a lower rate. What it guarantees is that Alex will know if the number he's offered is fair instead of just hoping it is. If you're someone who double-checks the numbers before signing anything, that's exactly why this channel exists. Stick around. Coming up, I'll show you how much Alex saved just by asking that one question first. Same car, same credit score. 2 very different rooms, and only one of them knew there was a second number in play. Let's follow the number. This is the part nobody explains. When a bank agrees to fund your loan through a dealership, they give the dealer a rate called the buy rate. The 2 words the hook promised you, and the exact 2 words dealerships hope you never ask about. It's the lender's rate before any dealer markup. For Mark and Alex, that rate was 5.5% on a $38,000 loan over 5 years, a fairly typical loan for the kind of car most people are shopping for. But the dealer doesn't have to give you that rate. They're allowed to raise it, often by 1 to 2.5 points, and just call it your rate. Nothing on your paperwork has to say otherwise. The extra money goes straight to the dealership. And here's where it gets expensive. On that $38,000 loan, 5.5% comes out to about $725 a month. Mark signed for 7.5% instead, about $760 a month. That's a $35 gap. Small enough to shrug off, small enough to sign right past. But stretch that $35 across all 60 months of the loan, and Mark quietly paid about $2,100 more than his credit earned him. Same car, same bank, arranged in the very same building, just a different outcome. Alex, holding his own number, kept every dollar of it. And this isn't even the worst version of this. The average markup buyers see is smaller than what happened to Mark. And even then, people still lose over $1,000 to a rate they were never shown. This wasn't rare, it was routine. That rate markup isn't the only way the finance office makes money. It's just the biggest way. You're about to see why even someone who pays every bill on time still doesn't fully escape it. First, the rate markup we just covered. Nearly 8 out of 10 dealer-arranged loans have some markup on top of the bank's real rate. This isn't rare, it's built into the process. Second, dealers can also earn a flat fee just for placing your loan with a certain lender, sometimes a few $100s, whether they marked up your rate or not. So even a buyer who fights hard on the rate still hands the dealer a small win. Third, that same meeting is where warranties, paint protection, and service plans usually get pitched, right when you're least likely to say no to one more small add-on. Fourth, even the buyer who pays on time, every time, still made the dealership money the day the loan closed. Paying perfectly doesn't undo a rate that was already set before you signed. Asking about the real rate before you agree to any number is the best way to protect yourself from the biggest one. And this isn't an exaggeration. Regulators have taken action against Ally Financial, Toyota's lender, and an Illinois dealer group over discriminatory auto lending practices. In each case, Black and other minority borrowers were charged more than similarly situated white borrowers, not because they qualified for less. These aren't rumors. They're real government cases involving dealer pricing and financing practices. None of this makes dealer financing a scam. It just means there's a second room most buyers never get invited into, and asking to see it is your best shot at getting in. Now, to be fair, and this matters a lot, dealer financing isn't always the worst choice. Car makers sometimes run special deals, sometimes as low as 0%, to move certain cars off the lot. If that deal genuinely beats your bank, take it. That's not a trap. That's just a good deal. So how do you tell a real 0% deal from a headline meant to get you in the door? Here's the test. Real deals are tied to a specific car, a specific trim, and a specific credit score, not as low as, which really means some people get this, most don't. Say a dealer's website advertises 0% on a certain truck. You walk in excited, only to find out it only applies to one specific trim level you weren't even planning to buy, and only for buyers with near-perfect credit. Even that isn't a scam. It's marketing doing exactly what it's designed to do. The fix is the same either way. Ask the finance manager to show you the terms in writing for the car in front of you and your actual credit score before you agree to anything. The real problem was never that dealer financing exists. It's that most buyers never know a second number exists behind the one they're shown, so they have no way to tell a good deal from a quiet markup. Without something to compare it to, a fair rate and a marked up rate sound the same coming from the same friendly voice. So this isn't never finance at a dealership. It's simpler than that. Never let the dealership be your only quote. Get your own number first, then let them try to beat it. If they do, great. Take the deal and go. If they can't, you still have a separate offer to compare against before deciding how to finance. Remember that finance office door from the start of this video? The one Mark walked through without a second thought? Alex walked through the same kind of door. The difference wasn't the car, the credit score, or the dealership. It was one piece of paper Alex already had in his pocket. It sounds like a small thing, just asking one question before you sign. But that one question is the whole difference between the room Mark walked into and the room Alex walked into. Here's what changes the outcome. Just 3 things. Get pre-approved by your own bank or credit union before you ever step on a lot. Even if you finance somewhere else, that number becomes your baseline. Once you're in the finance office, ask directly, what's the buy rate and can you beat it? And treat the price and the rate as two separate deals. A great price can quietly hide a bad rate, and most buyers never notice the swap. Here's what that sounds like in the room. The finance manager offers a rate. You mention your own bank already beat it and ask if they can match or improve on it. Sometimes they will. Sometimes they'll land somewhere in between, like 6.5% instead of 7.5%. Better, but still not as good as your own number. And that's fine too, because now it's your decision, not theirs. You don't need to be pushy about any of this. You just need to already have a real number in your pocket instead of trusting theirs blindly. And if a finance manager gets defensive or annoyed at that one simple question, pay attention. That tells you more than anything printed on the contract. The rate that protects you isn't necessarily the one they offer first. It's the one you already have to compare it against. Whether the dealer matches it, beats it, or falls somewhere in between, that comparison is what makes it your call now, not theirs. Money Decoded. Once you see it, you can't unsee it.